Today on Go Ahead Ask, the definition of like-kind property for 1031 exchange transactions can include asset classes that investors would not even think would qualify as like-kind property. Let's unravel that today on Go Ahead and Ask.
Building wealth in real estate? Let the Exeter Group take the mystery out of how it's done on Go Ahead Ask.
Welcome to Go Ahead Ask podcast by the Exeter Group, where we try to unravel the mystery of investment real estate and provide better quality educational information for investors so they can make better informed investment decisions. My name is Bill Exeter. I'm Chief Executive Officer of Exeter 1031 Exchange Services. And the Exeter Group of companies includes Exeter 1031 Exchange Services, which serves as a qualified intermediary for all types of 1031 exchanges in all 50 states. It also includes Exeter Trust Company that serves as an IRA custodian for self-directed IRAs or individual 401k plans, as escrow agent for specialty holding escrows, as trustee for title holding trust or land trusts, and also as custodian for specialty custody related accounts. As always here on Go Ahead Ask, we encourage questions, topics, or even guest experts. So you can contact us via email at ask@exeterco.com, or you can call us at area code 619-239-3091. Again, that's ask@exeterco.com or 619-239-3091. And if you love Go Ahead Ask, please like it, subscribe to it, share it, and comment on it. We will respond to all comments on our podcast topics. Today, our topic is unraveling the mystery of investing in oil and gas interests, not only as replacement property in 1031 exchanges, but also as an investment in self-directed IRAs and other type of custody accounts. Investors are, often surprised when they learn what asset classes are considered to be like-kind property for 1031 exchange treatment. Like-kind literally means you're selling real estate and you have to buy real estate. It is as broad as that. So it is not condo for condo or apartment for apartment. It's real estate for real estate. So as long as the real estate is held for some type of rental, investment, cash flow, or use in a trade or business, it will qualify for 1031 exchange treatment. So things that you wouldn't consider real estate could include air rights, water rights, mineral rights, and oil and gas interests. And we're going to unravel that part of the mystery today. And today we're very excited to have with us an expert in the oil and gas and mineral space. It's Troy Eckard, who is the Chief Executive Officer of Eckard Enterprises. And Troy, thank you for joining us today. Welcome.
Thanks, Bill. Glad to be here. Appreciate you having me on.
Absolutely. Maybe give the listeners a little kind of background and overview of what Eckard Enterprises is all about.
Sure. Bottom line is I've spent the last 36 years specifically in the oil and gas industry in the United States. Started my career as an investment broker and financial advisor from that area, and slowly built my career around actual direct ownership of tangible assets in the oil and gas space. Now we have a family office. We represent high net worth investors all over the country who have made a conscious decision to use self-directed IRAs, 1031s, and regular investment accounts to directly go out and seek tangible assets in the energy space.
And what else would you think investors or even our listeners in general would want to know about you personally today?
Well, I'm 57 years old. I've been married 35 years. I've been with my wife since she was 16. I've got 4 kids, 8 grandkids are all coming on the way. But essentially, I'm very much a numerical financial economist at heart. I just happen to choose oil and gas as the space where I deploy that intelligence. I look at everything in a macro view. So for me, understanding traditional real estate, the stock market, cryptocurrency, all comes to play in how it affects energy and energy's role in the overall market. So even though oil and gas is my area of focus and interest for the most part, I bring a very, very broad background across the board in multiple asset classes because I believe that's what's necessary to, navigate today's investment climate.
So true. And does that mean you're dragging the family into the business with you, or or are
Well,
they running for the exits?
no, I'm a pretty smart guy. I think at times I have three daughters, and I figured the best way to keep them close to me so I could enjoy their company and my grandkids is I hired their fiancés and husbands. Now, one of my son-in-laws is president of my company. The other one runs our IT and strategy department. My son is a petroleum engineer. I hired him earlier this year after 5 years of working for major oil companies. And so I've surrounded myself with people who have the same work ethic, the same moral and same business acumen, with the idea that we can create a very safe and very conscientious place that high net worth investors feel comfortable in investing with.
Terrific. So do you have red blood, or is it oil flowing through the veins?
I'm thinking at this point, it's probably all crude oil looking at this point. And as I get older, it may get worse and worse. I'm probably that car that needs a 100,000-mile oil change at this point, Bill.
I always tease people and say it's not the age, it's the mileage.
Yeah, that's exactly right. True.
So one thing I've noticed when we're talking to investors about things like oil and gas, water rights, air rights, et cetera, is they kind of glaze over because it's one of those topics they don't know a whole lot about. If they've never really looked at it, probably scares them a little bit. So maybe the first thing we do is kind of talk about what are the different ways they can invest in oil and gas?
Well, let's start with the easiest premise. People don't invest in things they don't understand. And if there's any significant part of lack of comprehension, rather than looking at it or pursuing it or investigating it, they have a tendency just to stay away from it. I'm a little bit different. I'm a putzer. My wife sends me for a gallon of milk. I come back about an hour and a half later. She goes, "Where in the heck have you been?" "Well, I drove down 3 roads. I checked out 3 pieces of real estate. I looked at a tractor for such." She goes, "Why?" I said, "I just want to know information." So I'm kind of that contrarian. And as a contrarian, the type of investors who invest in the energy space are also contrarians. And they see that the public markets like the stock market and bond market, those are what we call our core fundamentals. And then you have traditional real estate, which is a fundamental that is a little bit more of a base asset class, but allows you to do it at your own pace and not quite so influenced by global market exchanges, et cetera. The oil and gas space allows an investor to invest in really one of 3 ways. I can invest in my traditional investment account, and I can either buy public stocks, I can buy ETFs, I can buy trust, or I can take one more step down the road and go, I really like the returns, but I don't want to be given a small dividend when I could really get the bigger slice of the pie. So now I want to go directly with my investment account and buy into a well, into minerals, into a land deal where it involves oil and gas. You take a little more risk, but you get a bigger slice of the pie. Then you now have, because of the tax rulings, you have the ability to invest in a self-directed IRA, like through Exeter's ability to handle self-directed IRAs. And you also have the ability for a 1031 exchange. And I look at it this way, Bill, the same way you probably do, that the IRS is the one who created the 1031 from the standpoint of approving it and allowing it. They also are the ones who set up the designation of assets that qualify. Very clearly, it says oil and gas and interest qualify for 1031, and they also qualify for self-directed IRAs. Why do they do that? Because it has the same components and attributes and characteristics as other like-kind assets, and it also gets the IRS what they want. They want an asset in the 1031 and under self-directed IRA that will grow, be accretive, and create cash flow to allow those holding it to actually increase the amount of taxable estates they have one day when they pass away. They want us to get rich and give them the money at the end. That's the truth.
So true. And that you bring up a good point in terms of the self-directed IRAs as well. When you get into the self-directed IRA world, and if they buy actual real estate in the IRA, the challenge is how do you manage that without going too far? If it's supposed to be a passive investment, and if you get involved with active management, it might actually become a prohibited transaction depending on how far you go down that path. So oil and gas interest is very passive, makes a perfect example of what would be great inside of a self-directed IRA. So maybe you can comment a little bit on the level of activity that an investor might have to have with oil and gas interest and mineral rights and what have you.
Well, that's a very good point, because I think a lot of investors get out of the side of the tracks. They get outside the rails. And the truth is that if you have open-ended liability, if you have additional capital calls, if you have additional exposure where you are truly considered a general partner, you're not going to qualify to be a prohibitive transaction. So I get calls all the time, Bill, where they'll say, "Hey, I want to buy into drilling in a well." And I said, "Can't do it. doesn't qualify, doesn't apply, it's not applicable. It's also not to your best economic advantage. I don't need tax write-offs inside my self-directed IRA. I need them to go against my active income. So the key is understanding the difference between working interest, where you're actually involved in the participation of drilling a well, or buying producing property, which is a passive position just creating income, or mineral rights, which take on no liability. It's just purely a net income receipt type of asset. So I think the biggest thing is investors have to make sure they know where they're investing as far as in the oil and gas, streamline, and how that applies to either a traditional 1031 or self-directed IRA. And most of them don't know, but they also don't ask. So what they do is say, I don't know, so I'm not going to ask anybody because I'm afraid they might trick me into investing. I'm different. I walk right into a bar and go, who's in charge here? Well, it's obviously the guy that's 6'8" with a baseball bat, so I go straight to him. I may get hit or I may learn to be his buddy, but either way, I got to know. And that's kind of how I see investing. You got to ask.
You do have to ask. And I wonder how many people who at least are probably our age that remember the series Dallas, and maybe you think there's probably too much risk in the oil and gas industry when it's changed a lot from back then to today.
Well, it has. One of my favorite shows is, of course, There Will Be Blood. Daniel Day-Lewis, predicts how it was back in the 1800s finding oil and gas, and it's a cutthroat business. The problem with oil and gas is it doesn't have a centralized source of data. You can't Google online and go, how do I buy working interests, not get burned? How do I discern who's a crook and who's telling the truth? So for as much data that's online, the honest answer is very few sources are out there that allow a novice investor, even an experienced investor, to say, how do I compare one to the other? You can find more information about cryptocurrency, which has been around 11 years, than you can about investing in oil and gas. So the key is that brings up a heightened sense of awareness where maybe investors are reluctant. They don't get comfortable. I mean, you can do brain surgery on Google, but you can't find out about oil and gas. So I go back to the same thing, Bill, just like with your company. I'm going to go to Exeter because I believe they're the most honest, trustworthy firm that gives me all the professional support. And then I have jackwagon, IRA custodian. I'm going to say I've given myself a much higher level of risk because it doesn't have all the components that make common sense. I think common sense is the key. The second thing is 90% of your success is going to be based on the manager. And what you said is absolutely true. Wells we drilled in the 1980s were vertical wells using 2D seismic, 3D seismic. It'd be like going to your doctor right now. He's got an abacus on his desk to calculate your bill. You'd be like, I think I'm going to go to another doctor. Today, the oil industry uses the same technology sending a spacecraft to Mars, the same technology Elon Musk uses for his driverless cars. We're using those computer chips and software to guide our drill bits within fractions of an inch using triangulation to drill 2 miles in the ground. So it is a very, very technologically driven industry today compared to even 10 or 20 years ago.
So true. We're going to take a quick break for a message from our sponsor. This episode is sponsored by our sister company, Exeter Trust Company. Did you know that all individual retirement accounts are self-directed IRAs? It's because you choose where to put them. You choose whether to put your self-directed IRA at a bank or at a securities or brokerage firm or a life insurance company. So that makes it self-directed. But did you also know that all IRA custodians are not created equal? Most IRA custodians, like the banks, the securities firms, and the life insurance companies, limit you to publicly traded investments such as stocks and bonds and mutual funds. But some IRA custodians, like Exeter Trust Company, allow investors to invest their IRA funds in other alternative assets such as real estate. Investors can acquire real estate, mortgages, deeds of trust, or tax lien certificates inside the IRA as an investment inside the IRA. To learn more, call Exeter Trust Company at area code 307-222-8750 or visit them on the internet at exetertrustcompany.net. And we're back with Troy Eckard and Eckard Enterprises talking about oil and gas investments. And Troy, maybe we can drill down a little more on what type of investments would be appropriate for the self-directed IRA and or the 1031 exchange versus outside of a 1031 or outside of a self-directed IRA.
Well, let's start with the inside the 1031. I've made a great investment. I've created some capital profits, some capital gains inside of my real estate. I don't want to pay the taxes. I want to move it and try to be accretive. I'm looking at how I can move those dollars into a like-kind exchange asset class that's going to give me the same kind of characteristics, cash flow and growth in the asset base. I'm probably more likely to look at buying minerals using my 1031 than I am interested in a producing well. Producing wells are like having a swimming pool that you're draining. You're taking out reserves that aren't going to be there. They're going to be less and less each year, whereas mineral rights, if they're bought properly, can be bought early stage where there is actually growth in the asset, long-term cash flow. I think a 1031 is more applicable for mineral rights if I'm doing a 1031 exchange. Now, inside of a self-directed IRA, this is about a timeline. I'm looking at some finite time based on age and requirement where I'm going to have to start taking mandatory withdrawals. I want zero losses. I only want gain. I want the income in the self-directed IRA not to be taxed. So I want cash flow, cash flow, cash flow. You can buy working interest in producing wells, which means you actually own interest in the well, and you can also buy mineral rights. I personally don't believe any working interest belongs inside of a self-directed IRA because at some point in time, those wells will become uneconomical, and I'm going to have a look at the capital cost in order to plug and abandon those wells if I don't sell them earlier. Whereas mineral rights, when it gets down to the end of a producing well's life, a mineral rights owner has no obligation, no capital cost, and no liability. So I can go as a mineral owner until the last droplet of oil comes out and it costs me nothing. It's 100% passive and accretive. To me, mineral rights make more sense in a 1031 than a self-directed IRA. That's what I think the idea. Now, there are other investments you can make inside of your self-directed IRA, like pipeline investments, saltwater disposal wells, but there is a lot of elements of uncertainty and risk involved in those asset classes far beyond the simplicity of, let's say, owning a mineral right. So they can be done, they're just more complex and more risk involved.
And then if you were to invest outside of a 1031, just with out-of-pocket funds or outside of a self-directed IRA, so it's really just out-of-pocket funds, a pure straight investment, what would you recommend there, or what are the options that might be available there?
You can do the exact same thing inside your self-directed IRA and 1031 is outside, but the additional investment class that you now can invest in as just out of your ordinary investment account. And this is where we have really our high income earners really focused on participating in drilling wells because under the current tax law that President Trump put in place in 2017. If I make $1 million in income this year and I don't want to pay maximum tax rate, I want to reduce my gross income. For every dollar I invest in a domestic drilling venture, maybe I put $100,000 into a 5-well drilling program, the minute I write that check, the IRS recognizes that as 100% loss from an IRS calculation. So I go from $1 million to 900,000. So instantaneously, I get the advantage of my tax liability as a credit. I can go invest in other things. The second thing is because of the success of drilling today, we're now running probably in the horizontal drilling about a 98% success rate. I get a big write-off with very, very little risk, which means that is exactly what I am looking for. Immediate value, cash flow, returns, return on my investment. And I think the thing that also to keep in mind is that under the current administration with Biden, he's talking about removing some of those write-offs because in his opinion, it's only for the wealthy, which is not true. It is for high income earners, but it's for those that are willing to be contrarian and take that risk. And the reward is it creates domestic production, which helps the economy. Remember that macro view I take, helps the economy keep energy prices down. So I think the key thing for investors outside of 1031 or self-directed IRAs is there's a lot of different investments, but I want to make one statement your listeners should probably listen to carefully. When somebody tells you to invest in a drilling venture to get you a tax deduction, you only get a deduction when you lose money. And so that means I'm going to go drill you a dry hole or an uneconomical well and you're going to get a 100% write-off. I prefer to call it a tax deferment. If you participate in drilling and the person that's drilling the well or presenting that drilling opportunity, I should be expecting to make your money back in a profit. We're really going to use the write-off this year to defer the taxes owed in 2021 down the road as my wells come online and generate income. So even though it's called a deduction, I would much rather you lean on me and say it's a deferment because I plan on making you money from the wells that are drilled. Most people don't do that. They say, give me $100,000, I guarantee I can lose it. Well, I can do that in Vegas.
And that actually triggered a thought. In some cases, you're going through a 1031 exchange and you intend to go out and buy real estate and it fails for whatever reason, especially in this market. It's really a tough market. you're getting multiple offers and bidding wars, et cetera. And so you may not be able to finish your exchange, and it fails, and it triggers all of your tax consequences. So that could be a program where you turn around and buy into these drilling programs you're talking about, get that dollar for dollar credit to offset that taxable gain. Again, you're deferring down the road, and then you'll have revenue down the road.
Yeah, Bill, we have a lot of investors that have very, very complex investment portfolios and strategies and 1031s and self-directed. And in our case this year, we'll do about $50 million in mineral rights acquisition. We then put out a survey to our partners, said, how many of you are looking for tax deferments or deductions in 2021? It's kind of like ordering off a menu. Our partner said we need about 10 million in drilling. We then take a look at the different ways, whether it be an IRA or whether it be a 1031. We actually have a list on our board that says, here's all the 1031s that are waiting for the money to get to the QI so they can execute. And because the way mineral rights are offered based on a per acre price, we literally are like filling a menu. If you brought me a 1031 exchange client today and says, Troy's going to need 500,000 in exchange, he expects to have the money in QI by September 20th, we will set aside the minerals for that executed project because we can buy the inventory as we see needed, or we can stop, unlike having to do large transactions and close on a self-storage building or something else. So it gives them a very quick solution if one of their 1031s falls apart, and it makes a great complementary alternative choice if they want to kind of blend their portfolio between traditional real estate, maybe add some energy to their portfolio. And we're seeing our doctors and clients doing this all the time right now.
It probably takes a little bit of the risk out of the 1031 exchange. If you can set it aside, then they know they've got it waiting. And when they're in their 45-day period, they can also close on acquisition in the 45 days. So that eliminates that risk of what if I can't close on it? Yeah,
that's absolutely right. And the other thing, the advantage we have is, let's say you have a 1031 exchange customer, he puts the money in, it gets to the QI, he's got 45 days. That investor, that 1031 client of Exeter can say, I'm really more interested in growth than income, or I'm more interested in income than growth. We can actually blend that, because with oil and gas, you got literally hundreds of wells that are being drilled. You got 30 states with production. If you have the right company who's done the homework, built the team that allows you to kind of go select off the buffet, a lot of our clients or referrals from professional groups like Exeter will come to say, here's the exchange, here's the dollar amount, here's what the client's growth orientation or income. We then will put together portfolios and say, here's what we recommend. And the client can say, I'll sign off, I like that. And then at that point in time, we can actually set those assets aside for that executed 1031. It's a very, very easy and very nice way to blend into traditional 1031 decisions.
That makes perfect sense for a lot of different reasons. And I think probably the next question we get from investors is often, okay, tell me about cash flow, profits. How does that work with an oil and gas? Maybe if you can kind of run through that, let an investor know what kind of returns, what kind of cash flow they could expect, and how that works.
So we'll break it into two parts. We'll do the drilling first, then we'll do the minerals. It's fairly simple. In drilling, if I put $100,000 investment into a drilling program today, I'm going to get my immediate 100% write-off. If I'm in the 37% tax bracket, I save $37,000. I've got $63,000. I'd like those wells to produce an income, which effectively gets me back to even. I look at after-tax returns, and what my goal and what our projected anticipated returns are is 100% cash-on-cash return in under 48 months with a target of about 36 months. So if I don't look at my taxes, I want to see 100% return on my money in less than 36 months. So that comes in kind of what I call an accelerated return. If you participate in drilling today in horizontal wells, you might make 30 to 50% of your money back in the first 12 distributions. Write a check September 1st. Your first check comes probably March 1st next year, 8 months, then every month thereafter. But I'm looking at 36 months, 36 distributions. I get 100% of my $100,000 back. And then I may want to sell that asset in 4 or 5 years and accelerate the return, cut off my liability, and of course, accelerate the rotation of dollars. Minerals are a little different. Minerals are being like the landlord. You own the land. It's a 100-year lease. You're letting a major oil company go drill all the wells, spend all the money. I don't care if they drill 100 wells. I don't pay for any cost. So the economic model behind that is I put $100,000 in mineral. About 6 months later, I get my first check. Every receipt of royalty from minerals comes without any expenses or costs because we are the landlord. We pay no expenses. Once I get the first check, it catches me up for those 3 or 4 months it takes the oil company to recognize my ownership. And then I get a check every single month. And as the minerals are developed and more wells are drilled, my revenue can continue to go up. I've now booked proved reserves in the ground. And so the difference between the two is Our target rate of return is 10% per annum or greater. We believe that we will liquidate assets in the 5th to 10th year for an overall rate of return better than 15% per annum. In the last 3 years, Bill, our portfolio has generated just under 14% average rate of return year over year. So we're above our expected rate of return. We're buying minerals at a good price, but we always go conservative, say just look for a 10+% rate of return, no expenses, no exposure, totally passive. That's why minerals make a great self-directed IRA investment for you.
Perfect. And of course, the one thing we should also talk about too is risks and downside, and what should investors be aware of when they're making these types of investments?
Well, first off, there's two people that have their job every day of the week and they're wrong. That's the weatherman and the geologist. So you have a lot of you have a lot of risk when you allow somebody subjectively to decide where a 7-inch paper plate hole should be drilled in the ground. So the way you avoid the risk is you move up the food chain. And the way you move up the food chain is, I don't necessarily think that being on the drilling side is your best place to be if you're trying to avoid risk, because we don't know how the well is going to turn out, if it's going to have mechanical failure or how good a well it is, right? But what I like about buying mineral rights is if you buy mineral rights the way we do it, we're literally buying under wells that are already producing, already online. We already know how good they are. So it's kind of like buying a 35 to 50% occupied apartment complex. We know what it's capable of doing. It just has a lot of room for growth by getting higher occupancy. The biggest risk, Bill, and you and I know this from our years of business, is management. Because the oil and gas industry is one of those obscure sectors that very few people are experts in, it allows for a lot of unscrupulous characters to be involved. And so my recommendation as far as the risk composure is, use that Google search engine and put in their name and put in cease and desist orders, put in complaints and lawsuits. Write in Johnny Brown, scam artist, cons, SEC, cease and desist. And you see these massive amounts of disclosures come out. Let's face it, Google can give somebody a bad rap if somebody doesn't like you. I could go on now and put my best friend's name and say he's a pedophile, and he's going to have a hell of a time getting it off there. Let your common sense prevail. If you've got 100 posts and 99 say this guy's a crook, a criminal, and bad, then you better know he's bad. The other side is you can always just do a little research with the SEC, with the State Securities Board, and say, is this person have any prior convictions or et cetera? Management's key number one. And like you're always available, exposed. If that owner, those managers do not have an open door policy and allow you to come sit down and say, I have never done oil and gas. Can I spend an hour with your team and find out how to do it? If that's not an open invitation, you should close your checkbook, walk out the door, and keep moving. It has to be a relationship expectation. That's how you mitigate the risk.
And that's a key point. And going back to the very first comment you made too, which is you've got to understand the investment. So you've got to sit down and get this. You've got to learn it. You got to really understand what you're getting involved with. If you don't, you're asking for trouble.
Yeah, we actually, Bill, we find that the complement to what we do here at Eckard is that a lot of our clients, 20% of our clients are lawyers. My lawyer goes, you're selling lawyers? I go, we have lawyers as investors. He goes, that's crazy. No, it's not. It's great. If a lawyer is willing to sign our contracts and invest, that's a great sign. The other 30% of our clients are engineers, petroleum engineers buying minerals and oil and gas with us. We're thinking, surely you have access to your own. No, I don't. Not the way you bring it. We've got about 25% that are doctors. We have a lot of clients that are investors that are very meticulous when it comes to empirical details. They want facts and figures, not a bunch of arm waving. And what I'm getting at to your comment is that it's not that I got to make them a geologist. I don't have to make them a PhD in minerals or drilling. They have to know at least the working process. How do I write the check? What are my tax advantages? When will they cash flow? When should I get out? So we take and built a team of experts that handle that back office operational, kind of like your business. Behind those signs behind you is a whole army working on your client's business. But the front line is Bill Exeter has given them a packaged professional environment that says, we know what to do and how to help you, and we'll educate you to however deep you want to go. If you want to be just at the surface, we can do that. If you want to know what kind of pencils I buy to write your next 1031 contract, we can show you. That's the key. The key is you, the investor, decide how deep you want to be educated and learn, and that's totally what we're here about.
Perfect. This was some great, concise, quick information to get investors up to speed. If they want to learn more, how do they get in touch with you?
Simplest way is just call our 800 number, 800-527-8895. I've had the number since 1991, 800-527-8895. Or you can always email me, teckard@eckhardenterprises.com. I will make sure one of our wealth managers, one of our operational team helps you. You're not going to be put in a corner. You're not going to be trapped into a deal. We like to do what we're doing today with you, Bill, because we believe there's probably at least 10 to 15 million millionaires out there and high income, high net worth investors who are saying, I've got to find options because as the market changes, if I don't change and use the tools available like a 1031 or self-directed IRA, I'm going to be boxed in the corner with tax law changes, market changes, and lack of opportunity. So this is a way for you to reach out and ask questions, learn more. Then you ultimately write the check. You decide whether that direction's for you or not. And that's the cool part about this type of educational format is we're telling you, you make the decision which way to go.
Absolutely. Certainly, providing better and more educational information is always the better way to go, because that way they go into it with their eyes wide open and they understand what they're getting into.
Exactly.
So great information as always. So Troy, thank you for joining us today. Yes, thank you for listening to Go Ahead Ask podcast. Our last episode was discussing buying hard money notes and private money notes inside of a self-directed IRA. So if you want interested in that, go back and check that out. We just posted that this last Tuesday. As always, again, if you have questions, you have topics, you have a guest you want to appear on Go Ahead Ask, contact us at ask@exeterco.com or give us a call at 619-239-3091. Again, that's ask@exeterco.com or give us a call at 619-239-3091. And if you love Go Ahead Ask, please like it, subscribe to it, share it, comment on it, and we will respond to all of the comments. Thank you for listening, and we'll see you next time.
Thank you for listening to Go Ahead Ask with the Exeter Group. Join us for our next episode when we further unravel the mysteries of real estate.